Hello and welcome to the latest investment market update. As we move into the second quarter of the year and hopefully better weather, we wanted to give an update on investment markets. I'm Brian Morman, Chairman of Brunston Financial, and today I'm being joined once again by Mark Shields, Investment Director at Brooks Macdonald. Brooks Macdonald have been carefully selected to manage the Brunston investment funds, and using their expertise, the team analyse movements within the market and make tactical changes. In this video, Mark will be answering some topical questions and provide us with a wider context as to what has been happening in investment markets. So, Mark, good morning. How are you?
Very well, Brian. Very well. Hope you are too.
Mark, fixed interest rates. We've recently seen bond yields rise once again. Can you talk us through the cause of this, please?
Yeah, you're absolutely correct. So bond yields have come back up again. They obviously came down quite significantly in the early part of 2024. Well, actually, they started declining in the last part of 2023, but they sort of declined the largest amount at the start of this year. And that was quite simply because we saw some better inflationary data, predominantly out of the US, but also out of Europe and the UK. And that led investors to conclude that we were likely to see interest rates coming down, and that is good for bond markets. And essentially the bond yield moves inverted, or is inverted to the price of the bonds. So we saw the bonds price go up. Now, what's happened more recently is that we've seen inflation actually be stickier. And we've seen, whilst inflation has come down, it sort of seems to have sort of plateaued at a certain level, especially in the US. And that has now led investors to conclude that we're not as likely to see the same degree of interest rate cuts from central banks that was being priced in by markets at the beginning of this year. And in fact, there are some commentators who suggest we may even have further rate rises at some point on the horizon. And off the back of that, we've seen bond yields move back up again. They haven't quite reached the peak that they got to last year, but they're not that far off, certainly in the US. Again, Europe and the UK, the move up hasn't been quite so severe.
So thinking about that up ahead, Mark, how has this affected the portfolios and your positioning?
Yeah, so the main sort of impact really, because we've seen another kind of degree of correlation between markets and between bond markets and equity markets, I should say. Usually they're relatively low correlation, or indeed inverted. However, at the moment we're seeing quite a high degree of correlation between the two. So as bond prices are selling off, we're seeing equity prices sell off as well. So this month has been a tough month for equities in the US, at least, with I think the S&P's had its worst month since September 22, I believe. So there has been quite a bit of pressure on equity markets. There has been a bit of pressure on bond markets as well, and that has obviously fed through to the performance of the portfolios. Within the bond space, certainly with the cautious fund, whilst we have steadily been pushing duration out, by that I mean investing into longer dated bonds, and longer dated bonds are typically more sensitive to interest rates. So whilst we have been looking at investing more into longer dated bonds, we've very much kept our bias in short dated, and they're much more defensive. So actually our relative performance as those bond yields has come back up again has been quite good, because we've maintained the more defensive stance within the bond market. Equally, within equities, the largest amount of pressure we've seen has been within the US, which also has been the market that's performed the best over the past 18 months. But again, we've been a bit more diversified than that. And in fact, over the past month or so, whilst the US market is down by around about 4%, the UK market is up around about 4%. So, you know, our relative overweight to the UK has meant that we've mitigated some of the impact of that within the portfolios.
Okay. Turning to the Middle East, what are your thoughts there with regard to the recent flare-up in tensions, Mark?
Yeah, obviously it's you know, kind of we're seeing more kind of issues resolve themselves within the Middle East. We've seen a sort of spike in tension between Iran and Israel. And off the back of that, again, we saw oil prices spike up quite significantly. We try not to draw too much into the geopolitics of the world, but it is something that we are keeping an eye on. Clearly, higher oil prices have a bearing on inflation, so it is something that we are monitoring, as it were. However, I think it is worth pointing out that it seems to us, at least, that both Iran and Israel have been very keen to de-escalate once they've sort of saved face, as it were. So certainly with regards to those tensions between Iran and Israel in the near term, we expect that to maybe fall by the wayside. But still clearly tensions within the region as a whole remain high. And there are other geopolitical issues around the world as well that are very difficult to predict, but are adding to a degree of risk sentiment at this point in time.
Okay, then. So bearing in mind interest rates, inflation, Middle East, and tensions in the world, what are your thoughts on the direction of markets over the next few months, Mark?
Yeah, I think it's going to again boil down really to what we see in the data, the economic data predominantly, inflationary data as well, and what we see and hear from central banks. And we are possibly at a bit of a sort of divergent point at the moment, where the likelihood of rate cuts from places like Europe and the UK is maybe, immediate rate cuts, I mean, is maybe a little bit higher than the likelihood of rate cuts from places like the US. But you're getting better economic growth from the US. So it's a bit of a sort of difficult kind of situation to really kind of read through. I think at the moment that our positioning within the portfolios is gives us good exposure to either outcome, really. We've got a bit of exposure to the UK. We've got a little bit of exposure to Europe as well. If we do see them cut rates, sooner, and that part of the global market perform as well, then we should have elements of the portfolio that will benefit from that. But equally, if we do start to see inflationary numbers come down in the US, then we do have our positions over there that should do well off the back of that as well. But I certainly think the immediate near-term performance of markets is likely to continue to be dominated by that inflation and interest rate story as we go through the sort of summer months of 2024. And we'll have to see if those rate cuts that are now priced in for sort of September, October time, whether they materialize or not.
Okay, Mark, well, thank you for those insights, and thank you for watching. As always, if you have any questions or queries, please be in touch with us. Thank you.